Hi, this is Mike Maloney, and I've got Ronnie Stofferle once again from Incrementum AG with the In Gold We Trust report. Ronnie, how are you doing?
Very well, Mike. Good to see you again.
Great. So, what's next on the agenda here? You've got this great chart book with all these great images in it. Tell us what you want to cover next.
Yeah, let's have a look at page 9, which shows the fiscal stimulus. And, Mike, I think 1 trillion US dollars used to be a really big number, but we're getting used to it. So for our readers, we try to make those big numbers a bit more comprehensible. So we combined the two last fiscal packages, the CARES Act and the American Rescue Plan Act, each 1.9 trillion. And then we said, okay, let's line up $1 bills for those two stimulus packages. And how high would it be, or how far could we travel? And actually, we could go from Earth to Mars and back again. So that's a pretty long distance, as we know, even though Mr. Musk wants to travel it at some point. But I think it's really important to make those big numbers more comprehensible, because we know that austerity is out. We know that taboos have been broken, and nobody really cares about balanced budgets anymore. So big government and uber Keynesian policies are back, but I think it's really important to put to make comparisons about those great numbers. Just to give you some additional numbers, since the beginning of the COVID-19 pandemic, we added roughly 24 trillion to the global debt mountain. So now we are reaching 281 trillion, which is a global debt to GDP ratio at 360%. In most countries, we're now approaching the same levels like at the end of World War II. So actually, we're seeing the highest debt levels in peace times. And for us, it is simply impossible to grow out of this debt problem in real terms. So that also means, from my point of view, the higher the debt levels, the less likely it is that we will really see a sustainable turnaround in interest rates. So in the report, we say, before we see highly positive real rates again, it is more likely that a Dutch skier will win the downhill race in Kitzbühel. So what that means for gold is that the environment going forward with negative real rates should be very, very positive, and that the biggest threat to the price of gold, rising real rates and high positive real rates, is basically not existing anymore.
Yes. Yeah. We are just in trouble. People do not realize how far away Mars is. This is an incredible distance that this currency stretches. And, they used to say a billion here, a billion there, and after a while it adds up to real money. Well, it's currency, not money. But now it's trillions. And trillions it's just an incomprehensible number. And we're getting used to it, and we shouldn't be getting used to it. In the United States, we used to have a half penny because a whole penny bought way too much stuff. Now there's nothing that you can buy for a penny. So these numbers are getting way out of hand, and it is all because of government recklessness in their spending. And I like this thing with Elon Musk. I've met him a few times, and I've owned Teslas. My first Tesla was a 2010 Roadster, and so I've been driving Teslas for many years. Great theme, great imagery. It's just that Mars is an almost incomprehensible distance away from us. To be able to show that the currency that they're creating, if you printed all of it, could stretch there and back again. That's amazing. So what's up next for in your chart book here?
Of course, the question is who's going to finance all of that? And as we can see on chart number 10, yeah, central banks are creating trillions of new currency units every year. And that clearly confirms our view that the current system is not sustainable. And if you have a look at this chart, you can see that those numbers compared to 2008 and 2009, they're significantly higher. So, the great financial crisis looks like a kindergarten party now. And it seems just for the United States, I think they have to refinance roughly 9 trillion this year. And who's gonna buy it? I think at current rates, it's not gonna be sane market participants. While I have to say that treasury yields in the US really look highly appealing compared to the Eurozone, where now even Greek debt is almost trading at negative yields. So in the Eurozone, probably the situation is even worse now. The ECB has, I think for Austria, I think they have bought roughly 80% of all net issuance last year, and that goes for most of the other countries as well. So long story short, I think central banks will have to continue financing the debt, and there's basically no way out of that.
I absolutely agree. And one of the things that I see when I look at this chart, we were talking about a monetary system in its death throes. And if you look at the year-over-year change in central bank flows before the 2008 crisis, this to me is like a top that's spinning and it's very stable. And then it starts a little bit of a wobble and then it goes white like that wobbles more and more and more and does another one of those big things. And then after a while, the wobble gets really big and it flops over on its side and the whole thing's over with. It crashes.
Yeah.
And we're in that wobbling state right now where, it's had that first little whip where you sort of realize that the whole game is over with. And that was the 2008 crisis. And since then, the wobbles are getting bigger and bigger and bigger. And this is, I don't know, could this be the end right now? Will they be able to patch it up for another couple of years? I don't know. But I know that something enormous is coming and it's not too far away. And I do know that for me, cryptocurrencies might do well so far, we've seen cryptocurrencies do well in what was not a financial collapse. We'll see what happens when there's a real financial crisis here, because so far we haven't had the crisis. So anyway, let's move on to your next chart here.
Let's have a look at chart number 11, which also confirms that our view that this is not transitory. It shows the year-on-year growth of M2. So I think it's important to say that, first of all, last year M2 grew by almost 25%, which is significantly higher than in the inflationary 1970s. But one major difference compared to the great financial crisis, where actually M2 and M3, they collapsed because the problem was in the banking system. The whole banking system basically was frozen. Now we're seeing within the crisis that that monetary growth is rising significantly. And this basically confirms our view of this so-called monetary climate change, because something has happened last year. And I'm very grateful to Russell Napier, who did tremendous work on that topic. Governments handed out credit guarantees. So basically that said, dear banker, you can give out that loan, that credit, to companies, to private individuals, whatever. We've got your back. So we are guaranteeing that nothing will happen. And I think this is one of the most important changes that we saw last year. And I think this is really responsible for the fact that within this big crisis, actually monetary growth was rising significantly. Um, and as you can see on this chart, as I've mentioned, it's significantly higher than in the 1970s, which were, I would say, quite an inflationary decade.
Yeah, and a decade that was great for gold and bad for everything else. Yeah, you know, the this again shows a monetary system in its death throes. If you ask me, this is it's all absolutely insane. I think that this monetary reset is coming, and like we said in the last episode, uh, the gold will be repriced. It'll be repriced eventually by central banks when they go for the stability of gold. The one thing that's great about gold is you can't create it out of thin air, so it gives you a stable currency supply. And there is a reason that so many central banks hold gold as a tier one asset. They say that gold is this barbarous relic, according to John Maynard Keynes. Well, if it's a barbarous relic, why didn't the central banks sell it off years ago? I want to thank you again, Ronnie, for doing this. This is a wonderful insights that you've got, and we're going to continue this in the next episode. So thank you so much, Ron.
Thank you very much, Mike. It's been a pleasure.